Two, one, and we are live.
Hello, everyone. Sarah Shellam here from Quest Trust Company. I'm up here in our Dallas office, but coming to you live online today for our Thursday class. And with us today, we have Paul Williams with Multifamily Geeks, who's going to be talking a little bit about multifamily investing, kind of going from single family to multifamily, what that's like, syndications, and things like that. We won't go too in depth, but we're going to give you a good brief overview of a lot of stuff that you'll want to know as an investor and as an investor using your IRA as well. Speaking of IRAs, if you do want to get started, of course, always feel free to talk to an IRA specialist like myself or any one of our certified IRA services professionals that we've always got on staff. You can always give us a call. It's 855-FUN-IRAs. But thanks for tuning in. We've got quite a few people online already. Got some people on Facebook as well. So I'll just kind of briefly give you a couple of updates on some of the events that we have coming up, and then I'll let Paul take it away. But some of the things that we've got coming up for you guys, we have an MCE, which is a mandatory continuing education class that we just had. We're going to be doing another one. So if you missed it, definitely be sure to stay tuned for the one that we'll have coming up soon. And also, we have QuestCon Live. So I know a lot of people are familiar with the Quest Expo that we've had. Huge success the past 2 years we've done it. Fortunately, we won't be able to do it in person this year, but we'll be doing it online. So definitely stay tuned for that. You can get early bird tickets right now for $69, and it'll come with a recording as well. That does end on the 15th, so do take advantage of that soon. Other than that, self-directed IRA Saturdays, we always have those webinars going on. And of course, Tuesday, Wednesday, Thursday, right here. But without further ado, Paul, feel free to take it away. Thank you so much for being with us. And I'll let you share your screen and kind of take over here.
Well, thank you, Sarah. And thank you to the Quest team. We really like working with Quest. And if you are looking for, they didn't ask me to say this, but if you're looking for an IRA custodian or people to work with, I think they are just about the best that there is out there. Super knowledgeable and some of the brightest people I've ever met are at Quest. So I want to thank you for Quest for letting for giving me the opportunity to join and share today. Like I said, my name is Paul Williams. I'm with Multifamily Geeks. I act as a visionary. We have different roles in the organization. And I wanted to talk to you about why invest in multifamily. So some of you may be wondering, well, who is Paul Williams and who are the Multifamily Geeks? Well, my background is education. I have a Bachelor of Science and undergrad in or postgraduate in education. I taught high school business and foreign language for 3 years. From there, I started a trucking business, ran that for 10 years, and then I sold that business in 2016 and moved just full-time into real estate. Now, I've been doing real estate since 2001, and as my trucking business was profitable, I invested the profits into real estate. Did that since real estate since 2001 and moved into the commercial space in 2014. So I've been doing this for a while. Now we just, I still do some single family and I love it. I do some flips. I've got some single family rentals and then I use that to fuel the multifamily investing. And so who are the Multifamily Geeks? Multifamily Geeks, there's 5 of us on the team. You'll see us on the bottom right of the screen. Ben, Lisa, my screen here is covering this, and then me and Beth and Max in the back. Ben and Max are 2 of the partners. Max has been in real estate since '96, Ben since 2003, and so we came together in 2017, formed Multifamily Geeks, and we just came together over the core values, which I'll share just a minute, and because we were investing in the same areas, same parts of the country. And you can see us at some of our properties, different events, investor tours, and then some of our properties. But, you know, when I first started investing with other people, the first and only thing that I really looked at was, what is the return? You know, this one gives 8%, this other one gives 10%. Well, I'll go with the 10%. And that was the only thing that I really looked at. And then over time, I realized that the people behind the pro forma, the people are more important than the pro forma. Pro forma is important, returns are important, but more importantly is who are you working with, who are you investing with, who are you giving your hard-earned money to, who are you trusting that with? And so we came together over the core values, and it's really been a fun journey. So our core values are team player, and that just means open, honest, and transparent. Humbly confident just means no arrogance, no entitlement. Do what you say, be realistic, but be reliable. Do what is right for the client, for the team, for everyone involved, and continually growing. Now, I lead with our values because we think that that is the most important thing. And then if we have these things, if we're doing these things right, then we'll always just do the right thing for everybody involved. Now, I kind of wanted to talk about single family versus multifamily, just because so many of us have experience in the single family space. I've done it for, well, nearly, next year will be 20 years in the single family. And I know many of you have rentals or have done flips, or maybe you've done private lending for others to do that. And so I kind of wanted to use this as a comparison. We could have picked anything, but I thought, you know, we could have picked the stock market. We could have picked a number of different investment vehicles. But I thought this was something that a lot of us could relate to give comparison. So the first thing with single family versus multifamily, and I'm starting out with a positive for single family. And before I share these, I want to say that I'm not against any kind of investing. I'm not here to convince you that your way of investing is wrong and mine is the right way. If you found something that works, keep doing it. It's always okay to diversify and find, you know, spread out your risk and things like that. But I'm not against any kind of investing, and I love real estate as a whole. So when it comes to liquidity, the single family houses actually are a really good option for liquidity, because you're often selling to an end user, somebody that's going to live in a house, somebody that's going to you know, buy it to live in, or they're going to buy it to add to their rental portfolio. Multifamily, on the other hand, is a much slower process, and you can't put it on the market and then have it closed in 30 or 45 days. It's typically you know, multiple months getting it ready, and then multiple months on the market, and you know, that can take quite a long time to turn liquid. So single family has an advantage over multifamily in here. And those are two. That's one of my rental properties, and then that's one of our apartment complexes that we own. Secondly is vacancy factor. How does single family compare to multifamily? Well, with single family, when you look at the vacancy rate or occupancy rate, if you have one rental and your one rental goes vacant, then you are 100% vacant. And of course, if you have 3 rentals and you have 1 vacant, then you've got 60, or you have 33% of your vacancy. Now with multifamily, the vacancy is, we still have vacancy, but you know, in the case, if you look at our apartment complex here, 268 units, if we have a vacancy, which we typically average about 5% vacancy, you know, one unit going vacant is what is that, a fourth of 1% vacancy. So the vacancy factor is kind of spread out over many units. And it really makes it nice because this is where it gives some consistency to your investment. And with single family and some other investment types, you can have a number of good months in a row, and then you have zero or negative income for multiple months in a row as you have tenant turn and vacancy and, you know, evictions, things like that. With the multifamily, it's really spread out over a bunch of units. And yes, we have surprise move outs and things like that. But overall, you see a lot of consistency, which is something that's kind of hard to achieve with the single family until you get up to a number of units to where you have that consistency. So I see that as a big plus for multifamily is the vacancy factor. Next one is passive income. Now, a lot of us have gotten into investing, especially in real estate, for the passive income. Now, I don't know how single family has been for you if you've invested in single family, but I got into it as for passive income. But then I realized that it didn't feel very passive. It felt more like a job as I would take calls from tenants and look at repairs, and I would be actually doing the work. Even when I hired a management company, which I've used a management company for 12, 13 years for my single families, it still has not, oftentimes it hasn't felt like a passive income because I have to watch this thing so carefully and look at my reports and have phone calls and conversations with the property managers. So with the multifamily, it's truly a passive income. Our investors invest with us. In fact, I've had, I'm thinking of one particular investor, but we have a number of investors like this that they've told me that, you know, maybe I'm inviting them to our annual investors trip where we show them the properties they own. And I had one investor tell me, Paul, the reason that I'm investing with you guys is because I don't want to be involved. I don't want to know the tenant situations. I don't want to, you know, have to do any of this. The reason I'm investing with you is because I don't want anything to do with it. I just want the money. And we certainly appreciate that. And one thing that I've enjoyed with the multifamily is that it can give you a true passive income to where you don't have to think about it. You don't have to worry about it. You just collect your quarterly distributions. When tax time comes, you receive a K-1 in the mail that just files along with your taxes. Makes it super easy and a true passive income that can build wealth or develop into a passive income. Next is the appreciation and valuation. Okay, so with single family, many of you know the single family is the value of a home is determined by the neighborhood. What did the house down the street sell for? And you know, we look at a half-mile radius for the last 6 months, and then we determine our appreciation is limited to what the neighborhood is doing. And sometimes that's fantastic because the neighborhood is really improving a lot and we're not doing anything. And then sometimes it just stays flat for a number of years. So with multifamily, one really cool thing that I love about multifamily is that we can force the appreciation. We can, unlike single family where we have to hope that the neighborhood improves, we have to hope that the prices and values go up. With multifamily, we can actually push the appreciation. How do we do that? Well, with multifamily, instead of properties being sold on a comparable basis like single family, it's actually you are buying a business when you buy multifamily, the large multifamily. And this is really true with a lot of the commercial real estate. you're buying a business and it's traded like the stock market as a multiple of earnings. Maybe if you're familiar with stock markets, you've heard, this stock is trading at 7 times earnings or whatever. Well, with multifamily, that's how properties are traded. That's how they're bought and sold, is we call it the cap rate, the capitalization rate, which is essentially, it's a multiple of the profit. So when we look at a property and we're evaluating whether to buy it or not, we always look for a value add component. What can we do to improve the property with our management, our systems that we've developed over the years? And when we look at a property and we see that we can increase the income or decrease the expenses, and we apply our system to the property, then we actually push that net operating income. We increase net operating income is basically, in layman's terms, it's the profitability before debt service. So we'll just call it the profit. When we can increase that profit through increased income or decreased expenses or both, then we can force the appreciation, because when we go to sell, the buyer wants to know, what's the net operating income? What is the profitability? When I buy this property, how much profit am I going to make? So we can, when we do that, when we increase the net operating income, we actually force the appreciation, and we can take the property and for simple terms, and I hadn't planned to do this, so hopefully it comes out right. But so on a 10 cap, which we don't see those prices today, but we'll use this for simple numbers. On a 10 cap, let's say that you have a property that is producing $1 million of profit, net operating income per year. At a 10 cap sale price, that would mean that the buyer would buy the property for $10 million. It's 10 times earnings, we'll call it. When we are able to improve that, let's say we improve it by $200,000 through better rent collections, reduced delinquencies. We've got some cool value add things that we do to improve these. When we improve that by $200,000 a year, $17,000 a month, $16,000 a month, something like that, then we improve the property by $2 million value. Now, if our down payment to buy the property was $2 million, then we've just doubled the investment. So, and there's a lot of things that goes into that, but that's kind of a simple overview of how we can actually push the appreciation, whereas you can't do that with single family. You're kind of limited to what everybody else is doing. So that's one thing that I just love about multifamily and commercial real estate, is that we can force the appreciation. Lastly, comparing single family to multifamily is the risk spread. When you have, and this kind of went along with vacancy factor, but when you have one single family, then you have one roof per unit, you have one electrical system per unit, you have one plumbing infrastructure per unit. So when you have, let's say that you have 10 rentals, then you have 10 roofs to worry about. You have 10 electrical systems to think about. You have 10 different insurance policies for that with the same carrier, of course, but you have things like that. And when you have to send a vendor out to fix something, or your property manager, then you're paying full market price for each repair, renovation, upgrade, and then a tenant turn can be very costly because you're having to send one contractor per property. Now, when you think about a large multifamily property and you've got 100 units, 200 units, 300 units, in this case, the picture you see of our 268 unit, I think it's in 14 buildings, and some of the buildings are connected. So, we'll have a similar number of roofs to that of owning 10 single family properties. But we start to see economies of scale in a number of areas because we have maintenance guys that live on site instead of having to call a plumber for $85 or $100 an hour, or whatever the case is. We have a plumber on site, on staff. We have property managers on the property every day instead of just when there's a problem. We have a property management fee, for example. Single family, you'll see around 10% for property management fee. When you get into large multifamily, you're looking at 3%, 3.5%, 4% maybe management fees, which is a tremendous savings when you're looking at all of the different, at how many units. The cool thing is that for the same cost, that the same amount of money that it would take to invest in a single family, you can invest in, say, 268 units or 200 units or 300 units. And so you have a risk spread that is just really difficult to get with the single family. And we could list off another 20 different examples of different economies of scale savings. The insurance, the taxes, having all that. There's just so many advantages for a multifamily. And again, I'm not down on single family or any other investing, but hopefully I'm making a compelling case to consider adding multifamily or increasing your multifamily investing. That's why, I guess that's why invest in multifamily. Now, I'm going to tell you, some people are like, well, is now a good time to invest? There's a lot of crazy things going on. Are the markets going up? Are they going down? Are they staying the same? What's going on? We got, crazy times right now. I think anybody would admit. Well, I don't have a crystal ball, unfortunately, but here's several things that I do know. One, they're not making any more land. So, we have a limited supply of land. We have a limited supply of real estate. And because of that, rent and property values are generally never decreasing. Sometimes we'll see a little while where they stay the same. Occasionally we'll see a slight decrease, but as a general rule, the rent amount is always increasing and the property values are always increasing. So is now a good time to invest? I mean, the property values are going to continue to go up. Rent is going to continue to increase. They're not making any more land. With the increased money supply, and I'm not an economist, but I know the current and the past administration have printed a lot of money. And I think what that does is, as we increase the money supply, that has to push inflation and that has to push prices up. And when you invest in real estate in particular, I think you're kind of freezing inflation because, think about the prices of a house, maybe in your neighborhood or where you grew up. Think about the price of a house when you were a kid. And, maybe the price of that house was a third or a fourth or a tenth of what it is now. And when you buy a property, and some people say, well, it's expensive to invest right now. Well, if you could look back 10 years or 20 years ago and buy properties at those prices, would you? And I think we'd all say yes. But, as you buy real estate now and you kind of freeze inflation and you enjoy the natural organic appreciation of rent and property values increasing, years down the road, you'd be like, man, I can't believe we bought that so cheap. It seemed expensive at the time. So is now a good time to invest? I say yes. Some people are held back by fear. What are the markets going to do? Let me put it in something safe, and their money is eroded. Their value, their buying power is diminished so much because it's just sitting in something that's earning 0.25% or 1% or 0%. And when they could be getting a minimum of, keeping up with inflation with real estate and some of the other investments. So is now a good time to invest? I say it is. What's going to happen tomorrow? I don't know. I can't predict that. What's going to happen in 5 years? Are things going to be as crazy next year as they are this year? I don't know. But I know that, but I believe that, by having it in real estate, we're keeping it in something that's kind of locked in, safe, and my money is safe. So is now a good time to invest? I say yes. Okay, so how does a syndication work? Some of you, I'm sure, are familiar with the term. Some of you may not quite know how it works. So I kind of wanted to give you like a kind of a high-level overview on this, and hopefully it'll help you understand better, help some of you. Okay, so first of all, before I tell you how it works, I'll just say it's SEC regulated, like many of the other, or some of the other markets. That's actually regulated by the Securities and Exchange Commission. So we are legally bound to a number of different things to keep investors' money safe and not do what we shouldn't do. And that gave me a lot of security when I started out investing passively, or as I've invested passively. So anyway, we're SEC regulated. There's multiple investors, one investment. Okay, so in a syndication, essentially what happens is the managers, organizers will look for and find attractive investments to invest in. And when we find an investment, negotiate it, then we will offer the investment out to accredited or accredited and sophisticated investors. We will allow them to invest alongside with us. Generally, the managers will invest also because, first of all, we believe in the deal, and we want to align our interest alongside the investors. But we bring investors together to invest in a property. Is all, like I say, SEC regulated. And then what we do is we buy the property, and then the managers manage it, and then the investors are passive investors in the deal. But you see on our next point, well, what about accountability, reports, and distributions? Well, okay, so we have a property manager on site, and then what we do is we manage that manager actively, and we get reports and we share information back and forth. And there's generally a monthly financial reports, bank statements, bank reconciliation, financials, P&L, things like that. And then generally there's a quarterly report along with a quarterly distribution. Now, of course, if you're investing from an IRA, that just goes straight to the IRA. And then if you're just investing cash from your savings or whatever, then you actually get money sent to you from the quarterly distributions from the operation of the business. And I think we've got some questions coming in, and we'll have some time at the end to address those questions. Hopefully you guys will, think of some good questions and ask, and I'll do my best to answer them. So that's kind of how that goes. You get monthly and quarterly reports, and then you get generally a quarterly distribution. Okay, so we've identified, we found, negotiated a property, a price for a property. We brought the investors together. Some of them are investing at different levels. Generally, the minimum is $50,000 investment. We buy the property. We're giving reports and distributions, and then we do our value add implementation. So whatever we identified before we bought the property that we were going to do, we start doing that. Whether it's better management, increasing the rents, improving the exteriors, doing some different things to add value to the property, decrease expenses, things like that. We do that value add, and then lastly, the property is sold and the profits are shared. Now, the cool things about the syndication is one of the things that I really like about this is that the investors are generally paid back first, along with a preset, we call it a preferred return. So essentially, the investors will get their original investment money back, along with a preset amount of return before any profits are shared with the organizers and managers. So when the property is sold, the investor not only has he or she been getting quarterly distributions for the duration of the ownership, but then when it's sold, then then they get this big bump at the end, and then that's when the profits are shared with the organizers and managers. Some people ask me, well, how do I get into doing this? Because maybe I want to buy my own 200 unit, 300 unit, whatever it is, and kind of do that. At first, that question used to stump me, but then I just realized, well, I could just tell people what I did, and it worked for me, and it worked for Ben and Max, two of the partners. What we did is we wanted to do the same thing, and it was just so overwhelming, all the number of different things that go into finding and buying a large apartment complex and then managing it. So what I tell people is you invest passively, learn everything you can, ask all the questions, look at the reports, and then see where you can start adding value to the management team, to the organizers. And then as you learn, then you become invited to to help in different parts of running that. So I guess that's my 2 cents on that. So that's kind of how syndication works. And there's a lot of reasons I love multifamily and investing and in syndication. And I love talking to the investors and showing them the before and after pictures of what we're doing and things like that. It's essentially, in one sense, it's a giant flip. After having done about 90 of those myself personally, and Ben and Max doing some of those, and then getting into commercial in 2014, I just love everything about the multifamily, and so that's why I like investing in multifamily. Okay, so here's how you can connect with us if you would like. You can go to multifamilygeeks.com. You can see our bios, some of our properties, some pictures. So we do an annual investor trip to let investors, invite them to tour the properties that they're invested in. Here's how you can reach me or Ben. We're the investor relations guys. And then other ways to connect with us, you can go to facebook.com, multifamily invest, and that's how you can connect with us. You can fill out a confidential investors questionnaire. You can, follow us, let us know that you want us to send you information, and if you just want to learn and not even invest, connect with us. We'll answer whatever we can. We love talking about real estate. We geek out over real estate, and so if you want to just, maybe see the deals that we have as we have opportunities, connect with us, give us a phone call, and we'd love to talk to you guys. So I don't know, Sarah, Juan, if you guys have, if we want to open up to questions, I'll be happy to try to answer whatever questions I can.
Absolutely. So we have one question online. And guys, if you do have any more questions, feel free to type them into the chat box or in the comment section on Facebook. We'll want to get those answered for you. But we have one here. It says, how easy is it to get your money out of a property once invested?
It's okay. Generally, the time frame for a multifamily investment is 5 years. Now, sometimes we've been able to provide an outstanding return and do that within a year, year and a half, 2 years. But it's not, to be honest, it's not very liquid. It's you can't just call up and say, hey, I invested 50,000 with you guys 3 months ago. I kind of need it back now. There's, sometimes there's an opportunity that another investor says, well, I want to, increase my investment, or maybe we can buy you out. But that I wouldn't plan on that, because that's not always an option, just kind of depending on what everybody has. So I would say if you think you're going to need the money and, on moment's notice, this would probably not be a good way for you to, good place for you to put your money.
Okay, and I know that you might have mentioned this already, but what's the average investment time? 2 to 5 years, or what's that?
So we tell people 5 years, but our goal is to buy and implement the value add and sell the property as quickly as possible. Now, generally, we're operating off of a 5-year time frame. We tell people 5 years, and then sometimes we will get an unsolicited offer for the property that beats all of our expectations within the first 2 years. And then sometimes even before we've had a time to fully implement our value add. But I tell people 5 years is kind of the time frame. Which, one thing I forgot to mention earlier, it's kind of a positive on the single family is the liquidity, but honestly, some people don't want to have to reevaluate a new deal every few months and decide, do I trust these people? Do I, can I give them this money and get it back and with a return? Some people are very happy to put it there and not have to place it somewhere else for another 5 years. So 5 years is the general time frame, but it can go sooner, it can go a little longer, but 5 years.
Okay, another question that we have, what's a good way for investors to decipher the quality of that property? If they want to invest in it, is quality the only thing that they're looking for, or are they looking at long-term dollar?
I'm not sure I understand the question, but you have to think about what your goals are when you're investing. And if I don't answer your question the way you're asking, then feel free to clarify. So you got to think about what your long-term goals are. Are you looking for absolute preservation? Are you looking for growth? Are you looking for, and we only invest in properties that we are as certain as we can be that there's just as least possible risk of loss and the highest possible the highest probability of hitting our numbers and things like that.
So you guys aren't really looking for fancy properties or things like that. You're just looking for what the dollar's gonna show the best money for.
Yeah. So yeah, thanks for clarifying. Yeah, we are. We don't look for properties that come with bragging rights. Oh, I own this fancy property in the hottest part of downtown. We are looking to give a very competitive return. I didn't know that returns could be this good when I was in single family and when I was investing in the stock market. And when I saw it, I was like, is this real? That I can get on some of our early investments, investing passively, getting 30% per year. And I'm not saying that that's what you're going to get. We typically shoot for 15 to 20% between the cash flow and between the sale at the end, the appreciation. But we look for solid B and C properties, which means not the not the hottest part of downtown, or not the the most distressed areas, we look for just really solid performing properties in a path of progress, emerging market where things are really happening. The jobs are coming, businesses are investing, things like that in a part of the town that's, in a city that's projected to keep growing, and there's good reasons for that. So.
Awesome, thank you. And we actually got an influx of questions. We got about 5 just came in. So first one here, how many investors do you normally have participating in your projects at one time?
Well, it kind of depends on how big the project is. And, sometimes we will have one investor come in and, okay, so a typical investment for us can be anywhere from about $1 million to about $8 million or so. That's kind of our typical amount that we're raising. Sometimes we'll have one investor come in and want to fund the entire thing or a majority of it. A lot of times we will end up with, it's kind of, this is a big range, I guess, but, we'll range anywhere from 5 or 6 to 25 or 30 investors in a deal. We like to keep it as low as number as possible so we can just kind of provide the highest level of service to them.
Gotcha. So another question here. I think you may have answered this. What's the minimum for an investment, the minimum dollar amount?
Usually 50,000, and usually we take sophisticated and accredited investors. A sophisticated investor is just someone that is, in simple terms, it's someone that's capable of evaluating an investment to determine if it's the right thing for them. And an accredited investor is, in simple terms, it's a high net worth or a high income person.
What are your thoughts about new multifamily construction, the pros and the cons there?
Well, the pro is that you don't have, there's very little or no maintenance that has to be done for the ownership of the property, which is fantastic. It's just a really smooth deal. The con, though, is that we don't see real attractive returns. Because a lot of times the ones who are buying those properties are insurance companies, hedge funds, and they're okay with making a total return of 5% or 6% per year. And, we want to offer, a very competitive and very compelling return. And so that just makes it difficult with a new construction.
Gotcha. And these two kind of similar questions here. What's the typical minimum rate of return paid to your investors before managers participate in returns from sale of property?
Okay, so there's generally a split. There's usually what we've done is there's an 8% preferred return. So let's say the investor invests $100,000 with us. There's the preferred return, 8%. And we own that for, let's say we own it for 5 years. So the investor gets his 100,000 and 8% per year for the 5 years. So that's another $40,000 there before any profit is split. So essentially the investor is, treated preferentially that way. Now we invest alongside, so we invest our own money into these deals. So we are paid the same way that investors are or whatever we invested. But once we pay our preferred return, then it goes into a split. And in the past, and currently we do a waterfall split so that above 8%, we start getting 10%, above 12%, we start getting 20% of the profits, and above 30%, above 15% return to the investor annualized, then we get 30%. So we've aligned our interest. So we are incentivized to give our investors the highest return, because that's how we make the most money, is when we make sure our investors make the most.
Absolutely. As a small multifamily investor, what's your recommendation for GRM or cap rate to purchase?
It's kind of hard to answer that because it depends on what part of the country you're in. So even though I'm near Austin, I live near Austin, and my two partners are in Los Angeles. We invest in Atlanta, within a 3 to 4 hour drive of Atlanta, and so it where we invest, maybe the cap rates are 6.5%. Maybe here, I don't even know what the cap rates are here locally because I don't pay attention to the market. I know in Los Angeles they're 3.5%, 4%. So I mean, I would want to get I don't know if this is a good answer to your question, but I mean, I would see what the cap rate is around you, and then when you look at the value add, then you can kind of calculate what kind of return am I going to get? How long is it going to take me to get it? And and then is that an acceptable return to you? Now for us, if the current cap rate is 5.5%, then we will try to buy things at say a 6.25%, 6.5%, and then usually what we'll do is whatever we buy it at, we project that we are going to sell it at even at a higher cap rate, which just gives us a really conservative pro formas.
All right. Well, I think that's actually all the questions that we had. I know we have about 10 more minutes here. If we did have any other questions, you guys get them in. But if you had any last minute words that you wanted to say, I'm about to post your link to your website as well in the comments here so that they can contact you. But yeah, it looks like we're all with the comments there.
Sounds good. Well, I really appreciate the opportunity to speak. And like I say, if anybody wants to reach out and just talk about single family or multifamily or any aspect of real estate, we just try to be try to give as much value as we can. So we would love to have you guys connect, maybe fill out the investor questionnaire, or just let us know that you'd like to receive deals, or so you can call or text or something like that.
Can they get presentations from you if they send you an email?
Yes.
Perfect. Yeah. All righty. Well, thank you so much, Paul, for being with us. And guys, remember, if you want to get registered for QuestCon Live or would like to participate in any of our other webinars, register at questtrust.com or on Eventbrite to get those tickets. But stay tuned with us on Saturday as we come to you with our next webinar. And thank you so much again, Paul and Multifamily Geeks. All right.
Thank you, Sarah. Thank you, everybody.